So, when do we use covered calls? Well, covered calls again is holding already 100 shares of the stock and selling a call higher up because we believe the share price will stay still or fall down from here for a temporary period of time. They're best used when a correction is about to happen, which you best use this when you see a strong counter trend signal and an uptrend in the stock. That's telling you that there is a big probability right now that the price will not continue up but rather go down. Also, this should be done when you have already made a significant profit, of course, in the stock investment, and the stock looks very overvalued intrinsically, or you see that you can enter a better investment with the cash you can take out from the stock and overall than you used in covered calls. So I want to let you know that you never use covered calls if you do not intend to sell 100 shares. If you don't intend to sell 100 shares at all, don't use covered calls. Don't chase the money. Don't chase the money if you just see like, oh, I can just sell covered calls and make a passive income. No, 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 no. If you need to be aware that, there could be a possibility that the price can go up, your options stay in the money, and then your options are exercised and you have to sell your 100 shares. So you need to have the intention that you do want to sell 100 shares, but maybe you don't want to sell it right now. You want to sell it at a little bit higher price. So you would do a covered call. So a great company won't. The reason why is because a great company won't fall as much, but it will rise always eventually. So you need to be careful, right? So within the best way to use covered calls is when there's a correction about to happen, right? So right here, chances are likely because there's a top right here and the price has gone up and it's far away from the 20 moving average and it's overbought. Chances are, and it's reversal and many other different things, there chances are that the price is going to go down from here, or at least stay, or at least not go up for a period of time, which is my analysis. I don't see the price to go below the current strike price, which could be, or to go above the current strike price to be in the money. So this example is Bank of America. I've entered actually Bank of America when it was at $21 because at that time it was intrinsically undervalued. But if you see now, it's at $50. So in total, I've made a profit of $29 per share. That's about a 138% ROI. But now I see that it's very overvalued and the price is overextended. So it's hitting many resistance areas, as I said, and it's overbought. So I'm not thinking, I'm thinking of not selling the shares yet because it is still a good company. But I don't mind selling them at this point because I saw that there was another attractive investment somewhere else that I could put that cash that I realized from this if I do sell it, that shows a better return on my investment in the long run with that other investment. So what I will do is then sell a call out of the at the money since I'm very bearish and I will collect a premium of which I'll eventually show. So the reason why I sold a call at the money is because I was very bearish. Why was I very bearish? First, it's hitting a strong resistance. It's overextended from the price. It's far away from the 20 moving average. It's showing a reversal candlestick pattern. It's overbought. That's very bearish. I don't see the price going up from here. I see the price just staying at this level or going lower for a temporary period of time. So I would want to do a covered call because I already own more than 100 shares of the stock. So I'd like to, I'm thinking of I don't want to sell it yet here, but I don't mind selling it at a higher price because I do see another return on investment on another stock that I could put my money into by liquidating 100 shares to put that cash into another stock. So let's look about that. So Bank of America, this is the option chain for Bank of America at that time. I chose to use a at the money because I'm very certain it's hard for the price to go up because of a very strong resistance on price, reversal pattern, overextended, and it's overbought. If you see the premium here, which is the mark price that I would choose, is $1.51. That equates to 2.9% of the entire sell. The entire sell is the strike price plus premium collected. So as you guys know, in cash secured puts, it used to be strike price minus premium, but in this case, because it's calls, because it's calls, you have to do strike price plus premium collected times 100 shares is 51. Let me do the addition. 50 plus 1.51. That's about $51.50. Now times 100 shares, of course, that's $5,000 and $5,151. So that meets our criteria. The other thing is that the delta, of course, is within our range of what we want for a very bearish movement. And of course, if you do at the money calls, it has to be within the delta that I explained. And again, it has to be like that if I'm choosing something very close to in the money. The option here, as you see, the expiration date is at 45 days. So that also meets our criteria because we're looking something between more than 30 days and nothing more than 60 days. So I decided to sell this call at a 50 strike price and collect a premium of $1.51. Now I want you to pay attention to this because so you guys won't be confused when you actually do this. When you guys sell a call, your max loss is always going to show infinite. Well, that's because of course the stock can go up as high as it wants compared to the stock where if it costed $100, where like this is for puts, like if you're shorting a put where it costed $100, of course all the way it can fall to is $0. So the max loss there is $100 per share. But when it goes up, it can go as high as it wants, which of course doesn't benefit the seller. But again, I'm not holding this for the long term. Second, I'm very bearish at the moment for the stock that it can stay below my strike price at the expiration, which is 45 days. So I'm pretty confident that the option, or at least the price, could stay below or at the strike price within 45 days. So it's not that I'm shorting the stock forever. I'm just doing it for a few months because I see it's hard for the moment for the stock to continue up because it needs more of a reason to do so, which can come from a correction or consolidation. And a consolidation correction comes between buyers and people seeing to buy again cheaper, and good things happening again in the company because a lot of people trade and invest by emotion, which is what we don't do, but we take advantage of that folly. So take the max loss on the order with a big grain of salt. So yeah, you can have an infinite loss if you decide to never close it, but only an idiot lets that happen. Our buying power here is $0 because again we already own 100 shares. The broker would not block us to sell our own shares, but either way, your net sale is always going to be $50, which is the strike price, plus the premium, which is $1.51, and that would give you $51.51. So I decided to sell that, and so 27 days have passed. You see that the price literally fell on its ass. It went below the longer term support, way below the very strong support, a strong support with a horizontal line. It went below that, and now really at this level, the price is obviously overextended. Like you shouldn't be shorting anything here. Of course, like you guys would be following the crowd. Don't do that. But you see that the price has completely dropped. And of course, my analysis here was correct. My option, even though there's 18 days left until the expiration, but because of this enormous drop, my option is now very worthless. I would consider here closing the call as a profit because, why would I let it expire if it's really worthless? Where I looked at the premium, and the premium's just like 3 cents away from being $0. So there's no point on holding the option if it's almost at the full premium that you can collect. Now, sure, I will pay fees, which is maybe I'll have to pay a net debit total for $5 or so, but I'd rather close my position now than the possibility that the price could completely jump up. And I don't think the price will go up to here, but it's a more surety and more it's a better decision to do based on realizing capital now to put it into something else. So the first call, this is the first call that we sold. Look at where it's at right now. It costs about, it's always good. Sometimes the price is that. Really, this is like 3 cents. You can see that the premium now is at 3 cents. Now, I'm going to close this option because of many things. First is that, the stock has dropped significantly. The second thing is that the premium on option, regardless of how many days there's left, it's basically almost at $0 now. Which if it's dropped, why would I sell my 100 shares too at a cheaper price when I know the stock is falling temporarily, which I know it can go up eventually. So I'd rather choose to close this call for a credit. Again, I'm not bothered by this slightly, and actually I'm happy about this because I was fine if I had my shares sold, but I'm not urgent to do so, which is why I did a covered call. But if you're urgent to sell your shares, you should just sell it manually at the stock price, because if you really want to sell it, if you really want to sell it, you should do it like that. But you shouldn't do a covered call. But for me in this, I don't mind still holding, neither selling it, because I get to do maybe another covered call later on when it's overvalued again. So again, if the company has changed fundamentally and it's not as good as anymore, you don't do covered calls. Okay, period. Like if the company has changed fundamentally and it's not as good as anymore, you don't do covered calls. Why? Because the price could drop down at any moment when it's at very overextended, more than you thought, and your share price would be affected. So you need to sell it immediately at top if the business has changed fundamentally. So you don't do covered calls because you don't tend to holding the shares within a period of time. No, you're tending to sell it now. So you sell it at the stock price because of the messy and lousy results it has now, which, that those results reflect the company, and the company reflects the stock price, which always happens eventually, and you shouldn't expect on the rise in the long term because of this. So at this moment, I decided to close the call that we shorted, and then I was able to close it for a very small debit of 3 cents. But in total, that will make me, I'll make $148. Now, you only close this, so you only close the position though to just, you only close the position if you see you can realize from closing the option, which is a profit, at least more than 1.8% return, as if you sold the entire 100 shares, of course. So what did I mean by that? Well, because I'm manually closing this option, even though there's still time left and I'm not letting it expire. I need to make sure that out of my buying it back, out of in total, my net credit, which is my PL open within this option, is more than 1.8% of what it is if I sold the 100 shares at the strike plus premium. And in this case, it is. It's way more than 1.8% return. You can see because I bought it just 3 cents lower than the whole premium, I still was able to realize 2.8%, which is a great return on my investment for my investment portfolio as a passive income. So think about it. If you do this 10 times, you guys already made, you guys will make 28% return in your portfolio while holding still these companies without selling them. I mean, you would sell them, that's your intention, but you can make, while waiting to sell, an additional 2.8%. So while my stock has lost value compared to a month ago, but with this premium, I was able to profit a bit of that lost in stocks with just having the price staying still or going down. So you can say in a way this is sort of like hedging your portfolio, which is great. You would be hedging your portfolio in a way doing covered calls by selling a call at a higher strike. Because of course, with this dropped, of course the valuation within my investment has gone down, but my covered call did offset that a bit. I was able to collect $1.48 per share, which per share is 100 shares. That would be $148.50. All right, so I decided to close that. Now here's another example, so I can give you guys a little bit more examples to expand the horizon. Now this is Starbucks. So I bought Starbucks at $59 because it was intrinsically undervalued, but now I'm thinking of selling it. But I'm not urgent though. So the reason why I'm thinking of selling it is because the company was great, but I do see it. I see it now racking significant more debt now than it used to have a few years ago, and that's because of COVID. 90% of that debt is to maintain their current operations because it racked up quite a bit of debt too, even before back in 2018, to eventually grow what they have within their business to sell, coffee or sort of projects to have a higher growth within their revenue. But unfortunately, COVID hit and not much people could go outside, of course, as you guys know, and not order coffee. But they eventually did. But that debt was too much. I didn't like that they used a lot of debt, 90% of that debt, where they barely had any cash. A big portion of debt was to maintain their current operation. Which, as you guys know me, if you've seen the investing course, I don't invest in companies that do that. So I saw that they were now stacking up way more debt than they used to have existing debt. So just to maintain itself, and I don't like that. But however, I'm not urgent yet because it's not a crucial issue right now. I don't mind owning it for maybe a few months, but it will reflect the stock price in a year or 2 years. So, I'm not urgent to sell it this week or this month. Like I can still hold it for a little bit of a few months, but I do need to be aware of the company because that can obviously reflect a bit with its intrinsic value. So of course, because of this, I didn't see it as attractive anymore than I used to. So I was thinking of using a covered call for this. I'm going to sell a call at the money because I see there's many different indications and price action setups too, and it's also intrinsically overvalued still, which I don't usually sell. But because this stock has somewhat changed fundamentally, I will be selling a few shares with covered calls. So a fun fact is, eventually when you guys reach the end of this video, I don't use, okay. I didn't realize there was a crop there. So I, because of this, I'm going to be doing a covered call, but I don't do this as much because when I invest in my portfolio, there's many different styles of investing, but the way how I invest majority is that my sort of psychology and my mentality within investing in great companies is that they're great. They're great companies, and because of that, I don't intend to sell regardless of anything. My intention within investing, because of my style and what I expect out of it, is that for me, investing is a net worth growth. I intend to reinvest whatever income comes out of that. I don't reimburse within different incomes that flow out of it into another stream. I simply just keep that there and keep pumping in cash because if a company is good and it's showing to do good and it makes sense fundamentally, you see that the company is completely overperforming any of its competitors where it doesn't even have competitors, and it's just a very quality, good company, then why would you sell? The power within fortunes is not selling, it's actually holding for long periods of times, 20 years, 30 years, which is my goal. But for some of you, if you decide to diversify, which is by 2 years, not 2 years, but 4 years to 5 years to 6 years, then you can do covered calls. Like again, it's just by personal preference. I do this sometimes depending on the type of investments I do within sort of a way to diversify the capital if I'm diversifying a lot. But if I'm not, I have a different set of I have different portfolios within a different investing mentality. But just to keep that in mind, like if you guys have the same mentality, I'm just letting you know you probably not be doing so much covered calls because you don't want to sell a great business. But I would do more cash secured puts than covered calls because I do want to enter in these great businesses when they're intrinsically undervalued. Just to let you guys know. So let's look at this. So I decided to sell the Starbucks call, and I decided to sell it at the money. As you see, the premium here is $3.62, and that's about 4% of actually of our net sell, and that's great. The delta here is also 52. And again, I'm choosing this at the money strike because I'm not bullish at the moment for the stocks to continue up, rather bearish to stay below our strike. So I will choose this expiration because I believe that it's going to be very hard temporarily for the price to stay above our strike. But I'm also aware of the possibilities, especially after what went on after the whole pact of incentivizing companies in this free money area in the markets and growing with zero interest rates. And basically, the Fed did a quantitative easing that they have done for the past few months. Also with an enormous amount of demand for certain industries via COVID to stay at home, because this was during the almost winter or autumn in 2020 that this is when a lot of that stuff started to play into effect. So again, but I don't base what goes on macroly. I just look at chart patterns, which is why I don't base my decision on that. But it is a consideration to manage somewhat my trade as an expectancy to go the other way when events happen. But again, I don't rely on what will happen. I rely on what's happening now. I don't predict anything. That's not my job. Like that's no professional trader. There's no professional trader that actually makes consistent results in the long term. No one predicts anything. I base my expiration on the possibilities seen environmentally for the markets to continue up strongly, which is why I choose 36 days and not more than 40 days, which is the only factor I put in a bit with macroly. But that's it. I don't trade the amount that I trade. I don't trade the amount of contracts. I don't trade the amount of my risk because of macroly. Fuck that. I don't do that at all. Maybe I base a bit with the expiration, but I don't differentiate whatever with my risk to return or my analysis. So I decided to do this order. I will sell this call, and I'm going to collect about, well, in this sense it's not, well, I mean in this sense it's $3.62, and for right here I'm just going to wait simply a few weeks and see what happens to the option. So remember, you need to make a decision when the option only has 7 days left until expiration, whether you're going to close it or you're going to let it expire in the money, which you sell your shares. That's based on what you see and what you want to do. So it's now been a couple of weeks. As you see, the stock actually hasn't moved as much. There is, at this point, there's only 7 days left until expiration. And I need to make a decision now, especially since the strike is actually in the money. So as you see, the option has lost a bit of its extrinsic value, as you see, since it's in the money by 24 cents. But only has an extrinsic of $1.44 compared to before, where it had $3.62. As I said, though, I'm thinking of selling my shares, but with a covered call. So I will let the option actually expire, worthless in this scenario. Whether it goes up or down, I will let it expire because if the stock goes up, I actually want to sell it, and I don't mind if the spot price even goes up way above my strike, where I have to sell it lower than what the current price is at, because I can't predict that to happen, whether it goes way above, but I know what I will make a profit at selling at the strike price to when I bought it as the investment, which is the most important thing, where I bought it lower and now I'm selling it higher with a good ROI in this investment circumstance. Because a lot of people do that. A lot of people go like, damn it, the stock went up and I sold it lower. Don't think about that. That doesn't matter. What matters is that whatever you bought was low and now you sold it at a higher price. It doesn't matter if the stock did tenfold or whatever. Like, that's something that you can't predict. What you can't predict is a high probability that the stock is likely to go down than to go up. Well, you're gambling if you let the option continue. because if you let the option continue, there's no difference from between you gambling there, because you're hoping now that the option will be worth now in the next 3 days than now, which is not my job. I don't do that. Because why? Because I don't want to lose money. I don't intend to lose money. So I'm serious in what I do. I do it with serious factual evidence within my analysis, and I factor in my risk return with that. But I don't see this as a game. I see it as a game, of course, but I don't see it to just play and have fun. You know, in the markets, you enjoy it, but you don't have fun. If you want to have fun, go to Universal or something like that. But this is serious. You're here to make the only thing here that the only goal that you're supposed to do in the market is to make money. All right, so just have that clear, because there's a lot of people that don't have that checked. Okay, so let's talk about the pros and cons in covered calls. So, what are the pros? Well, the pros is that you can earn passive income from simply selling like a cash secured put, from having the price stay below or at a strike price, while holding on to your shares, which net you should be slightly gaining if your stock is actually currently dropping, which is a great way to earn passive income while holding shares and simultaneously hedging those shares when the stock drops, similar to diversifying. Another thing is that you actually get to sell your 100 shares while also profiting in extra as a bonus if your option gets to expire in the money slightly. And another additional thing is that the strategy is best used, like if you don't feel like selling the current shares, the shares at the current price, but you don't mind selling them at a higher price now. This should be done if you already have 100 shares of the stock, but you see maybe another attractive investment that gives you a better return in the long run, so you wouldn't mind liquidating your current position to put that cash onto the next investment that you want to add to your portfolio. Now, the cons. What are the cons about covered calls? Well, the cons is that because of its nature, in a covered call, a stock can go as high as it wants. So even though you don't mind selling call, because you see the current price not be bullish, there's still obviously a possibility, guys, that the stock can go up and go against your call, which you might lose more than expected. And because of this, sometimes if the stock went up way too much, like way too much, it's nearly not impossible, but it's extremely hard for the price to come back to your strike because it's way far ahead. Whatever the stock is at, it's at a perimeter of movement. So the next time it drops in a correction, it's not even close to your strike price. Usually when it's in that difference, when you can spot that, then the worst that will happen is that you actually have to close the call for a loss and you can't roll it. Because if you roll it, you're just going to be ending up losing more premium because your stock's never going to reach the strike where you can let it expire. And you can't always predict the movement. So you will have times you're right, not right, right, not right. So that's the only con about it. And of course, because of its nature, you do need to have 100 shares of the stock. I mean, you can't do this without owning 100 shares of a stock no matter. Now, however, this is just if you have the investments. But in trading, of course, in this trading option course, there's countless of other trading strategies, guys, where you can benefit by also selling a call similar to this to collect passive income in your trades without owning shares of the stock while also having a much more smaller capital to do so. That's the awesome thing too, because there's an abundant amount of material in this option course that you guys will learn so many different strategies that are very beneficial, have given consistency into that. And one example could be the axe in this, where you can collect a passive income while holding, let's say, a long position is a diagonal spread, and a caller. A caller is mostly executed in a downtrend, but those are just two. There's others as well. So let's talk about the worst case scenario. What if the price goes above our strike by a big portion? Well, if you don't want to sell your shares anymore for some reason, just close the call and open a new one at a further expiration date to cover the loss of the first call. Of course, as I just said though, that if the price does go above your strike by an enormous portion, where you see that it's nearly impossible for the price to come back to that price level where it used to be at, like if it's history now, then of course you're gonna have to close the call for a loss. Because if you roll the call, now you're just hoping. Like how can you have some sort of certainty that the price can go down to that level or lose its premium when it's now at a different level? Like when it does a correction, it's not even close to that strike. So another thing that you guys need to remember is that when you're the holder of an option, the holder of an option will always lose the premium at expiration if they leave it at expiration date, which leaves the seller always with a credit, because since the buyer lost the premium, which is the holder, that premium, where did that premium go? It didn't just disappear. That premium went to the seller because he gave him the privilege to buy the shares at the strike price. That's what the seller does. It gives him the privilege. And the holder gives the seller into the profit from selling them. So it's like a mutual exchange of, a deal, like a service. So you need to let it. So as a seller, you need to let the full premium. To collect the full premium, you need to let it expire a lot of the times. Not all the time, but mostly a lot of the times. Usually, at the last upcoming days, will the buyer or holder of the option exercise that option if it's deep in the money, because they will make a profit from the share price in order to benefit intrinsically as a guarantee, like owning the shares. And that's why I say, also with another way of explaining, that's why I never let a call option exceed more than 80 delta, because usually when it exceeds 80 delta, as someone's analysis, this isn't a guarantee. Like, not every option buyer looks at the delta and says, oh, I need to exercise my options now. No, it's just that usually, based on statistically, does the holder of the option most of all exercise their option when it's more than 80 delta, because it starts to behave like the stock. So there would be that was their goal, to have it benefit as 100 shares of the stock movement.